Hello, everyone, and welcome to our webinar. My name is Amit Lalwani, and I am the SVP of Global Business Development at DealCloud. Today, we will share the results of the Spring 2020 Dealmaker Pulse Survey, along with some data-driven takeaways specifically for the deal professionals working for investment banking and advisory firms. Before we begin, to take a moment to review a few housekeeping items. We, the DealCloud team, are currently working from home. There may be an occasional background noise, and I hope you can excuse us for that. As Zoom experiences high usage volume, we may experience some connectivity issues or slowness. While unlikely, it's worth mentioning that if we or you have any issues, this session is being recorded and will be sent to each one of the attendees post the webinar. Lastly, participants can submit questions during the webinar via the Q&A function, and we will answer the questions at the end of the presentation. With that being said, let's get started. So just as an introduction, my name is Amit Lalwani, and I joined DealCloud about 2 years ago. I am responsible currently for our global business development efforts, and I work very closely with our prospects and clients to learn about their challenges, aspirations, and then partner with them to provide the right solutions for their firm. My prior experience includes running global account management teams and helping conceptualize and build technology products used by some of the world's largest investment banks for their deal origination and execution efforts. I would like to start by providing a little bit of context on our survey and how it was conducted. We issued our inaugural Dealmaker Pulse Survey during the last week of April so that we could gauge the trends and issues in the market, since we all know that the reality on the ground has changed so dramatically. Moving forward, the survey will be issued every 6 months. We will continue to focus the survey on the overall market sentiment, how advisors and investors are working together to close deals, as well as the unique ways technology can enhance their deal and relationship management activities. For this specific survey, we posed 10 questions that were focused on market sentiment and then specifically around 3 key areas. The first one was overall deal flow, the sources, the types of deals expected, challenges in the current market environment, since we find ourselves in such unique situations, and then how the respondents were thinking about technology. And as you would expect, we kept all the responses anonymous to ensure that the identity of all the respondents was not revealed and they could feel comfortable to provide their honest feedback. A little bit more about how we did it. So most of you may already know that DealCloud is a purpose-built deal and pipeline management platform, and we at DealCloud use our own technology for all our internal operations. What you see on the screen is Dispatch, which is our fully integrated marketing solution, and it sits on top of our DealCloud platform and is used by our clients for their external communication, be it deal announcements, newsletters, thought leadership pieces, or even announcing new hires. We like to say that we drink our own champagne at DealCloud, and we used our own marketing technology, Dispatch, to manage all aspects of the survey. So for this Dealmaker survey, we used Dispatch to create the survey page, to distribute emails requesting the deal professionals to participate, and finally to collect the anonymous results. If you have any questions about this component of our platform, feel free to visit our website at www.dealcloud.com, where you can find some more material on this specific piece of technology and also request a demo. If you are an existing client, please feel free to reach out to your account management rep who can help answer any questions and also arrange a demo. I'd like to share a fun fact here about Dispatch. We released Dispatch in the market about a year ago, and it was primarily driven by client feedback for an integrated marketing solution. And we're very proud to announce that we currently have more than 100 clients currently leveraging this component of our platform. Let me share a little bit about the respondents. So the demographics of the respondents of our survey are highlighted here, and we think it's important for you to understand who took the survey so that the insights will make a lot more sense. We are so thankful to all of those who participated in the survey and provided their insights. The respondents were a mix of clients and non-clients. Also, the respondents represented a variety of functions within the firms, ranging from partners and members of the executive committee, all the way to the members of finance and operations teams. Almost 2/3 of the respondents are currently involved in either the investment management or the IR function at their firms. More than 60% of the insights came from senior leaders, which are either directors or principals and above. And we also looked at the firm sizes and found that respondents worked at firms ranging from boutique shops with less than 10 professionals to larger groups with over 100 professionals. Also, the survey was sent out to a global list of recipients. So the responses represent views from a large group of respondents across the globe. Now that you all have some background on the survey methodology and the respondents, let's dive into the findings. One of the first questions and most obvious ones that we asked in our survey was, what type of activities does your firm anticipate focusing on over the next 6 months? It is likely to surprise this audience, but more than 1/3 of the deal makers we heard from are primarily focused on still acquiring new companies. Additionally, a great deal of attention will be paid over the next 6 months to companies in their portfolio, which kind of makes sense as the investors are making it a priority to provide support and bolster operations for existing assets. Almost 20% of them see the displacement in the market as an opportunity to do bolt-on acquisitions to their existing portfolio companies, and also are hoping to find bargains in the current environment. All of us have been impacted in some shape or form because of the COVID-19 pandemic and the disruption it has caused. Something that could potentially be viewed as good news is that less than 15% of the firms surveyed said that they are focused on mitigating negative effects due to the COVID-19 pandemic. I hope this means that firms are feeling a little better about the overall health of their own organizations and moving past the effects of the current situation and have gotten used to the new way of operating. Another question that we asked our deal makers was what they perceived to be some of their biggest challenges and barriers to executing on their investment strategy. Now, for this specific question, the respondents had an option to provide multiple answers. We learned that while firms are primarily focused on new deals, they were overwhelmingly concerned about the volume of attractive deal flow hitting the market. We found this to be interesting because this challenge doesn't seem to be amplified due to the current market conditions, but in fact has been prevalent in the private capital markets for a while now. There was no surprise that the second biggest challenge was securing capital from LPs who probably are skittish due to the volatility in the market and the mixed messages that they probably are getting from the public and private markets. We glean that from point number 2, that some of the GPs may not have great relationships with credit firms or lenders. And this might be a great opportunity to bring your relationships as investment bankers to the table when discussing the health of the financial sponsors' portfolio companies. Additionally, there's a relatively high level of confidence in the management teams at these portfolio companies to manage their way through the COVID-19 crisis, which we thought was a positive sign. A decent number of respondents are still concerned with the prices becoming irrational as well. So our understanding from this response is that though there is still record amounts of dry powder on the sidelines, the companies that have shown the ability to weather the current market or the ones that are gaining traction in this market are going to expect handsome multiples. And that absolutely is a concern with the private equity firms. The other interesting thing that we noticed is that if a financial sponsor has an exit plan, the public markets are still an option. If you look at some of the recent names that have come to market and the upward trend in their stock price, regardless of volatility, that is something to be keenly aware of, that the public markets are not completely shut down. Now, if you look at point number 6, if you have an expertise in regulatory and tax work and understand nuances of specific industries and regions, this might be a good time to leverage that part of your business and present it to the private equity firms or financial sponsors that you may be talking to. Let's take a deeper dive into the data that might be of particular interest for the investment banking and advisory professionals on this webinar today. We were quite curious to see if interests changed across the size of the firm. But it seems that there's a fair bit of agreement in the market, whether you are a big shop with 100 professionals or a small one with less than 10. Across these firms, investors agreed that a founder-led sale is not going to make up the majority of the deal flow. Investors expect to see more corporate carve-outs or recaps where they may realize that certain parts of the companies in their portfolio are better off being offloaded. Similarly, as an investment banker, you can probably add value by advising on a bolt-on acquisition that previously may not be part of a consideration. Additionally, a fair number of investors from both the big shops and the boutique shops are worried about the uncertain regulatory and tax environment in which they find themselves. Based on the results of this survey, the larger firms are 3 times more likely to be interested in your capabilities around regulatory and tax solutions. So if you're going to pitch a larger sized firm, we would recommend going within your expertise in a specific industry, but also bringing your regulations and tax implications for the industry to the table and speaking to them intelligently. With the COVID crisis, the PPP program, as helpful as it might be, is complicated to navigate, as the repayment and ramifications are understood by few. and these may impact the larger PE firms more than the boutique firms. This could lead to a great opportunity for investment bankers and advisors to provide value-added services to the private equity investors and their portfolio companies, especially when they are focused on a niche industry or a geographic region. We also asked investors, which type of deals do they expect to see over the next 6 months? And in order to help the investment banking advisors like yourselves on this call, we also decided to take it a step further and analyzed the insight based on the firm size. Since the size of the firm or amount of AUM is often an indicator of buying power, we thought this was a particularly interesting data set. As you can see, larger firms are more interested in corporate carve-outs, while the boutiques are more interested in the recaps. Also, if you are representing a founder-led startup, you may want to approach a smaller firm who is almost 3 times as much more interested in those types of deals compared to the larger PE firms. And we think the huge difference in the interest level from the larger firms compared to the smaller firms for founder-led sales was an interesting observation, and tells us that the larger firms, which are a lot more mature, though interested, are a lot more cautious and may not be motivated to jump on a strong founder-led company in this market, specifically if the multiples are higher than the pre-COVID days. Now, this slide should be of interest to almost all of you. This was a big takeaway, specifically for this audience, which was more than 80% of the respondents said that they believed the reliance on intermediaries as a source of deal flow will remain the same or increase over the next 6 months. And we feel that because a lot of the investors are focusing on existing companies, but they still have capital that they have to put to work, they may have limited time to focus on their own proprietary deal sourcing. And this is great news for a lot of the listeners on this webinar today. In the existing environment, bankers must leverage existing relationships and build new ones, albeit virtually, taking advantage of your institutional knowledge within your firm about your clients and combining that knowledge with your expertise in a specific market is going to be more important than ever. So we also had 2 recommendations based on the observations. The first one was pretty obvious, that we recommend that firms should be looking to invest heavily in their sponsor coverage programs. And they can accomplish this by highlighting their expertise and thought leadership in certain areas via webinars like this one, but also focus on more tailored marketing using white papers, key hires, and deal announcements to a targeted group of financial sponsors to get the most bang for your buck. The second thing that we would also recommend, that we've noticed that the digital marketing channels will absolutely be very helpful to help the firm's speed and efficacy. Now that we have less in-person conferences and networking events to attend, those kind of events were relied upon for deal sourcing. But now you will be forced to leverage your digital marketing channels. And one example that I'd like to put out there, we have seen one of our clients do a fantastic job of this. Raymond James has a complete section on their website dedicated to providing a lot of thought leadership to their client base, be it by region, by sector, by product. They also have a lot of current trends, deal announcements, as well as recent hires, which I definitely found very helpful, and I'm sure their clients find it helpful too. So obviously, as DealCloud is a technology-focused firm, we could not leave the technology question out of our survey. So we asked, does technology act as a competitive advantage? And the respondents tell us that this is a perfect time to look inwards to retool your tech stack to come out of this pandemic even stronger. So 49% of the respondents said that over the last 6 months, technology has allowed their firm to stay about even or at par with their competitors. An additional 31% of the investors said that technology enabled them to beat out their competition. And to us, it means that an overwhelmingly when private equity investors are using technology to help them better compete for deals and help maintain and grow relationships with bankers and advisors, just like yourselves. If your investment banking, advisory, or brokerage operations are not equally as sophisticated as the tech used by your buyers on the other side of the transaction, you may be placing your firm at a disadvantage. We know from having 150 plus banking clients that without a strong technology backbone, clients' expectations go unmet, due diligence processes get messy, and then deals tend to not go as smoothly as expected. If you feel that your firm's technology is not at least letting you stay on par, there are many technology platforms and data providers that can help. And we truly believe that those solutions should be considered to help you succeed. Another fun fact here, we at DealCloud over the past 3 months have brought about 60 brand new clients online. And that gives us very good indication that a lot of clients are leveraging this time where their bankers are not on a plane and they're not as busy to try and tech enable themselves so they can focus on web-based, purpose-built collaboration tools. And finally, for those who may be interested or know a little bit about DealCloud, we offer a deal and relationship management platform. It's leveraged by over 850 clients today. And we provide our services to investment banks, M&A advisory firms. And what you see on the screen are nothing but a series of best practices. So if you're a deal professional, you focus on your sourcing, deal execution, pipeline management. If you're focused on IR or business development, there's obviously modules and dashboards that help you focus on your industry coverage and geographic coverage. And if you're running a big team, there's also a component that helps you manage your business with all of these pre-configured dashboards. So those were some of the key highlights from the survey. And what I'd like to do now is open it up for some Q&A. Okay, questions have already started flowing in, which is great. So we have one here that says, we are trying to provide more restructuring services given where we are in the market. How can we use marketing to better highlight these new services? That's a great question. Restructuring recap seems to be the flavor of, I would say, this season for now. And one of the things that we have seen some clients do better than the others is, number one, take stock of what are your core competencies when it comes to restructuring. Are you focused on a certain size of company? Are you focused on a certain region or on a certain market cap? And then I would say identify a purpose-built marketing tool that helps you very specifically tailor a newsletter, announcement, new hires that you may have brought on to a very specific targeted group of clients where you have married up their preferences to your specialties. And that's what we think is going to help you get your name out in the market. But just as another side note, we've spoken to one of our clients who said restructuring is part of their business and they're moving a lot of resources from other areas of their business into restructuring, and they see themselves being busy for at least all of 2021. So it is going to be around for a while. The next question is, if PE firms aren't looking to divest yet, should bankers still get to know the companies in the portfolio? How do we increase the likelihood of getting to serve as an intermediary? That's another good question. I would say relationships are still the primary drivers when it comes to how you get in front of the right financial sponsor to highlight your core competency. So our recommendation would be, yes, absolutely, you should get to know the portfolio companies, but also staying top of mind is very crucial. So if you leverage some of your existing marketing strategies, make sure you're presenting to that specific PE firm why you in a specific industry and why you for a specific company. Get to know the company, get to know the management team, and it'll pay dividends in the long run. There's another interesting one here. During the COVID-19, how have investment bankers used technology to improve sponsor coverage? Oh, absolutely. One of the things that we have seen is when there was high deal volume, there was so much business coming into the door, you could get away with not having complete information when you were speaking to a financial sponsor. But during these interesting times, folks that are able to leverage technology are realizing that you could be having, depending on your firm's size and offering, multiple conversations with the same financial sponsor, be it for a carve-out or for a refinancing deal for another company in their portfolio or in a completely different region. The way the investment bankers are using technology is to make sure there's a single source of truth where every single touch point that is happening from your firm is being captured, so that the next time you pick up the phone and speak to your financial sponsor rep, you can provide the interactions that are going on across the entire firm and not just speak to your silo. There's another question here. When creating a sponsor coverage model using technology, how should we categorize and organize our data? What data points matter the most? Yeah, for this specific one, I would say, if you think about you having a conversation with a financial sponsor, and take, for example, you were talking to them about a biotech company in a specific region of a certain market cap, and they may not be interested in that, but they provided you feedback that we are interested in companies that look and feel like this, or have this kind of multiple, or has this kind of EBITDA range, or this kind of revenue. Where is all that information going? I think today, a lot of that information still resides in your head, or it's on a notepad or in emails. So one of the way we would recommend modeling your coverage sponsor coverage is identifying preferences and categorizing your financial sponsors based on, if I now have a mandate, sell-side mandate, to go sell a biotech company that's market cap of $100 million in this region, I don't need to go and speak to 500 of my potential buyers because I know their preferences. There might just be 50 who are interested in these type of companies. What that allows you to do is because of your categorization and organizing of your data, A, you are a lot more specific where you go and talk to your buyers, and B, the company that you're representing also sees that you are the expert and you're not spraying and praying, but you have a strategy. The next question here is DealCloud planning to do a banking survey? Yeah, we absolutely are playing with the idea of a banking survey. The next survey that we have going out, which will be in the fall, will be still focused on the private capital markets. But like I said, we've got 150 plus investment banking clients, and we absolutely are interested in doing a banking survey. So stay tuned for that one. There's another question. You listed lack of attractive assets to buy as a #1 challenge for PE firms. Is this a lack of visibility on deals in the market or simply not liking companies available? I think it's more of the latter, but again, this is just us making a little bit of an assumption because we had them answer specifically some categories. And I think it's the latter simply because, you know, there still might be a lot of companies out there, but let's just say with the COVID-19 pandemic, there's just a lot more scrutiny. And I don't think, you know, a year ago when everybody was buying the growth story, I think now people are a little more interested in not just the growth, but the stability and the sustainability of the company. So I think that's driving a lot of the lack of attractive assets. Let's see, there's another question here. Are metrics showing time to close deals with PE groups increasing significantly in 2020 as if slow rolling processes seems to be the primary mode? I think this is generally the trend that we are seeing. And I think the primary reason for this is historically, the due diligence process by no means was incomplete, but now I think the due diligence is a lot more comprehensive, a lot more thorough, and the buyers absolutely care about the growth story, but they also care about, with the new changing landscape, is this a viable business, not just 6 months from now, but a year, 5 years, 10 years from now. So we do see a little bit of the slow rolling, and I think that's a positive sign simply because the due diligence is asking a lot more comprehensive questions. Let's see. I think those are all the questions that we had for today. Let me just move on to the final part of our session today. So those were the results of the survey that we wanted to share. I appreciate all the questions that some of you posed, you know, at the end of the webinar. We would thank all of you for joining our webinar today and encourage you to download the full report from dealcloud.com/pulse. The actual report has a lot more insights than some of the high-level points and insights that we shared today. And as a reminder, this webinar was recorded and we will make it available on our website, dealcloud.com, shortly. Also, if you're interested, please feel free to visit www.dealcloud.com/webinars for more information on our other webinars, which are taking place on a regular basis. And also if you would like to see the recordings of some of the previous ones. With that, I'd like to thank all of you for attending today and have a great rest of your day.